When markets have been below their peak for some time, it can be helpful both psychologically and financially to remember that market downturns are followed by market recoveries. Psychologically, you'll be maybe rest assured that better days are ahead, and financially, you'll know to keep investing knowing that you're buying in at lower prices. Unfortunately, no one, including the experts, really know when a bear market will end. However, we do know that market downturns are followed by market recoveries. And so the attention shifts away from, well, when is it going to end, to how should we be investing during these recovery periods? And investors can take one of two approaches here. One approach that investors may choose to take would be more of an active approach. So that would mean putting more money towards or investing more in stocks of companies that tend to do better during this part of the market cycle, during the recovery part of the market cycle. So you might be looking at doing more investing into consumer discretionary, materials, real estate, maybe even industrials and energy stocks. The other approach that investors might choose to take during this period would be more of a passive approach. So instead of reacting to whatever the current or anticipated market conditions are expected to be, rather you just maintain your current positioning. So by having that sort of diversified portfolio, you eliminate the risk of potentially overweighting yourself to one sector that, well, it was expected to maybe overperform, winds up underperforming. As well, if you already are in a diversified portfolio, you're likely going to participate in whatever sectors wind up doing really well during the market recovery. So then the question, of course, becomes, well, if we're in a market recovery, should I be more in an active portfolio or more in a passive portfolio? Certainly, the active versus passive approach is a long-standing debate sort of in the investment community. But what it really comes down to for the individual investor is going to be what is their personal preference and what is their tolerance for risk or their ability to withstand risk. So we have to keep in mind that recoveries are always going to be a little bit different. In fact, a lot of times you're actually able to plot, over a period of time what the stock market's doing, and depending on the type of recovery, it'll follow generally a certain type of pattern. So for example, we might see something that looks like a V-shaped recovery. So this would imply that we saw a steep decline in the market and then we saw almost an immediate uptick. So that would be almost best case scenario. Other ways that we can describe rebounds would be something like a U, a W, or an L shape. Okay, so we can see that the recoveries often are different. They might look a little different. They can be long, they can be short, they can be smooth, or they can be bumpy. Sometimes the path to recovery, though, can be quite volatile. And so we see some investors choosing to hold back and stop making the regular contributions. They no longer want to risk their money going into their portfolio and then seeing it decline in the short term while we're still sort of through this volatile period. Now, they might choose to sort of wait on the sidelines, so hold off on making the regular contributions and decide to enter again when the market is in full-blown recovery mode. Of course, waiting on the sidelines and holding off on your regular contributions is a gamble in itself. For example, if you wait to invest, you might wind up catching the recovery when it's close to the end. And so you're going to be buying less units or shares of whatever it is you're buying because you're buying it at a higher price. And we often see this when investors do choose to wait because it's really hard to know, okay, when is the exact right time I should be getting in more? And when we see that the market started to recover, that's often when a lot of investors will want to get back in, but they've already missed out on buying at some of those lower prices. And so we often recommend for investors that might be unsure of what to do, to maintain their regular contributions even during the market recovery. And because it's going to be a diversified portfolio that we've put together that already aligns with their investment objectives, their risks, and their time horizons. On the flip side, other investors might see a downturn and then start of a recovery as a really big opportunity to buy into the market, right? Because at this point, you're able to buy in at cheaper prices. And so if they have maybe a lump sum savings or if they've received a large tax refund, they may choose to invest a lot of their money into the stock market when things are down. And while this can be a really great strategy, I just really urge you to pay attention to what it is you're buying, because you probably have a portfolio somewhere and you have certain, again, risk thresholds and time horizons in place. So if you are going to be putting a lump sum into the market, just make sure that whatever it is you're buying still ultimately aligns with your risk tolerances and that you haven't inadvertently put yourself way over your risk thresholds. If you'd like a second opinion with your portfolio, our team at Ferguson Financial Planning can help. You can schedule a consultation with us using the link below in our description. If you liked this video, I encourage you to check out our website where we post market commentaries and more information like this. And if you enjoyed the video, please like, subscribe, and leave a comment on what you'd like us to cover next. Thank you for watching.